Welcome back, everyone. We recently had two huge earnings reports, Starbucks and Amazon. These two companies also had very, very different outcomes. For example, Starbucks today is down 17% after earnings. To say that this was weaker than expected is accurate, but it's also an understatement. This was a disastrous earnings report. We're going to go into the details. We're going to share what's going on with this story. And we're going to observe my claim that I made 4 months ago. 4 months ago, I made a video saying that I believe we are entering into a caffeine bubble. It's something that's not getting talked about enough. Not enough investors are focusing on this little niche caffeine bubble. But I've seen it, I've spotted it, and I believe that this is the first real material evidence of that bubble manifesting today. So we're going to be looking at Starbucks. We'll also be looking at the Starbucks CEO. Just today, he went on an interview with Jim Cramer. And let me tell you, that interview did not go well. I know that a lot of people have opinions about Jim Cramer, but he grilled the CEO in this interview. It is devastating. It was difficult to watch. But we're gonna soldier through it. I'll take you through the interview. I'll give you my reaction when watching it. And we're going to go through the numbers on Starbucks and see if there's any hope for this company in the future and see what the future looks like. The other company, of course, we're going to be looking at is Amazon. It's up a little bit today on a red day, which is good. The Nasdaq's down 0.6% and Amazon's up 1.5% or 1.1%. So that's always a good day. It's up a little bit, but this wasn't the monstrous quarter that we expected. It's not up 10 or 15%. Amazon's just holding on to its gains. But there's a lot more to this story. There's a lot more takeaways. After time of looking at the earnings report, listening to the earnings call, and going through what I think are the biggest indicators of Amazon, I'm going to give you a full update. I'm going to give you a full review of the financials in context with what's going on with Amazon and how I view the company for the remainder of 2024. So this is going to be a lot of fun to go through both of these companies. I hope you enjoy this type of content. If you do, just on a side note, to gain access to Qualtrim, which you get all of this pretty data, you get access to hundreds of exclusive episodes, you can join the Patreon today, risk-free. If you join today, you get the entire month for free as a free trial. So if you haven't already, try it out. Today's the time. Let's go ahead and start off with Starbucks. Like I said, it's down 17% today. Now, the first thing I want to say about Starbucks is this is a company I really like. I think it's a really strong company fundamentally. It has great brand value. It does have pricing power. It's a company that has a great loyalty program. Starbucks has one of the best digital assets with millions of members using it every single day. And it kind of works as a form of a bank. They get a lot of capital from their app that they can use in future investments. So I've been someone that's actually been bullish on Starbucks in the past. But there's been something that's changed my mind over time. Something that caused me concern about Starbucks in the future. I saw this across the horizon, getting closer and closer and closer, and I finally decided to sell my position because I feel like the risks were increasing for Starbucks. We can see that in my trading. If we look at my portfolio here, you can see my trading history with Starbucks. I was buying it in like the 70s and 80s, around 2022. And then I started to sell the company early 2023. So we can look at these sells here. I sold 1,000 of it here for 105, 102 right there. My last sell, my big one, July 24th, 2023, I sold $3,700 of the stock, the last of my position, at 103. The reason I sold out of Starbucks was because I felt like we were getting into a caffeine bubble. 4 months ago, I made a video on this. You can go back and watch the video. I basically explained in this video that I believe there's too many companies entering into Starbucks' sphere. Too many companies. We have McDonald's having Cosmics, a new Starbucks-like drink type of concept where people just go through in lines. Around me locally, there's multiple places where you can go through drive-thrus and get your caffeine for the morning. You have Panera Bread actually killing 2 people with their highly caffeinated energy charged drinks. You have Jack in the Box coming out with an energy drink. You have other companies that are fast food companies transitioning to energy and caffeine-based drinks. They all want to get part of this high-margin industry, which is the caffeine-addicted consumer group. And not only do you have the fast food industries, the Jack in the Boxes, the Panera Breads, the McDonald's moving into Starbucks' category, but you also have a whole other category that I think has significant overlap. The category there are the Celsiuses, the Monster Energy, the Red Bull. Now you have C4 Energy. You have so many other companies moving into this energy drink sphere. So when I saw that on the horizon, I just thought, you know what? Starbucks is at a healthy valuation right now. It's fully valued. I've done well in the stock. I made money on it. I'm going to sell out now and move this money into companies that I feel a little bit more confident in. So that's my initial concern with Starbucks. And like many of these theories, you don't know if they'll really hit. You don't know if Starbucks is just going to go right through these concerns and maybe I sold prematurely and Starbucks would continue to go up and have great same-store sales. Or it might go the other direction where these concerns start to manifest through the numbers. Ultimately, the numbers will show you the truth. And this quarter in particular for Starbucks is the first time that I've seen real evidence of this caffeine bubble thesis starting to play out. I think we're starting to see real evidence here. Now, before we even go through the Qualtrim numbers, which look really ugly this quarter, I first want to show you some of the breakdown of just how bad this quarter was. This isn't just a stock selling down because of volatility or selling down because of a simple overreaction. These are really ugly numbers. We can look at the adjusted diluted EPS. That's the normal EPS number you want to look at. The Wall Street expectations were for 80 cents. They came in at 68 cents. So 15% below Wall Street's expectations. Revenue was also a miss. So they missed on the top and bottom line, revenue, and especially earnings. We have same-store sales percentage. This is a major KPI that you track for any type of restaurant, any type of retail location. You have it here at minus 4%. Now, overall, Wall Street was expecting positive 1.46%. So Wall Street was pricing in that they're going to grow same-store sales slightly. It came in minus 4%. This was also distributed throughout the entire globe. So this isn't some type of issue just between international or China or just the US. This was everywhere. Minus 3% in the US, minus 6% internationally, minus 11% in China. So China is getting crushed, the US is going negative, and everywhere else is going negative as well. Not great. And you can see that Wall Street was pricing in growing same-store sales everywhere but China. They had minus same-store sales everywhere, including China, and way worse in China than expected. You have the transactions, was also a huge miss. Wall Street was expecting it to be roughly equal, kind of in line, the same, minus 0.27, and it came in at minus 6%. So traffic volumes are going way down, both in North America and internationally. Again, you can't blame this on one single country or one single geography. You have ticket growth. So transaction is the amount of traffic, people coming in and out of stores. And then you have ticket growth, which is due to pricing, how much people are paying. Traffic is way down and people are paying slightly more, but still a miss on paying. Their ticket growth was 2%. Wall Street was pricing in 2.4. North America was 4%. Wall Street was pricing in 4.15. So that's one of the only metrics that they really hit. They came in with their ticket growth in North America. Not to mention, they missed North America's traffic by over 8%. Internationally, it was down big. Ticket growth was much smaller internationally, minus 3%. Then even in the new store openings, so you expect the company to continue opening up new stores. That's how they get new customers. Net new locations in North America was 134 compared to 144 expected. So they missed that by 7%. International was 230. Expected was 429. They missed that by 46%. So they're not opening up as many locations as expected. And this is what I'm referring to. No matter which way you slice it, no matter which way you look at this, Starbucks missed on everything. They missed on every aspect of every part of their earnings. There are no good highlights about this. It's really hard to find anything to be really happy about this report. So in some cases, I see stocks selling off and I shrug my shoulders. I have a hard time finding where the weakness is. In this case, I think this sell-off is largely justified. I think that investors were totally blindsided by what happened here. And I think that Starbucks did a really bad job guiding investors' expectations into this quarter. This was a huge communication breakdown between the management and their expectations and guiding investors in the right direction. obviously investors were caught way off guard. Now we go down to the other metrics here and we can see this show up in the longer term context. We look at the revenue here. I'll zoom in a little bit so you can just see this more clearly. See this last quarter? It's way down. Even from a year ago, you had it climbing and then all of a sudden it fell rapidly. So the latest quarter, it's down big time decline there. It looks unusually low. We look at the free cash flow and this looks like it's growing over time. So the free cash flow I'll give them looks okay, but there's other issues with the free cash flow. A lot of this money that they earned this quarter is already spoken for, and I'll go into that a little bit later. When we look at the earnings per share, here's the other big miss. You can see earnings per share declining year over year. If I zoom in a little bit here, you can see this more clearly. This is the most recent quarter. We go back 4 quarters ago. That's what it looks like right there. So it went from 79 cents down to 68. Decline in EPS year over year. Now, they were guiding for around 15% earnings per share growth. And now analyst estimates are wondering, even if they can become flat, even if they can just keep their earnings per share. That's how much of a blindside this was. When we look at the cash and debt, they took on more debt last quarter. So long-term debt's going up during a time where interest rates are higher, meaning that their interest on this debt is going to be much higher. And that's a problem for Starbucks. When we look at dividends, they're keeping their dividend, but this dividend's becoming an increasing amount of their cash flows, taking up a bigger and bigger proportion of their cash flows, leaving less amounts for things like paying down debt and doing buybacks. When we look at the shares outstanding, we can see a decline year over year, but it's not going down quarter to quarter. The shares outstanding was completely flat from this quarter to last quarter because they cannot afford to do buybacks. One of the key things I look for in my companies are ones that can afford to do buybacks if the share price plummets, because that's always a thing that can buoy the stock back up. It's a little bit of a margin of safety. If you have a company that has a ton of cash flow and it sells off big time, they can just buy back their stock over and over again, improving all of their per share metrics, making it so that it's really a matter of time until the stock goes back up. That's why I like investing in companies like Texas Roadhouse or MasterCard or Intuit. All these companies can pull a buyback lever if the stock price ever falls. The issue for Starbucks is they can't do buybacks. They can't afford to. This year, Starbucks is going to generate around $3 to $4 billion of free cash flow. Okay, so they have $3 to $4 billion of free cash flow to do buybacks with. Seems like that's a good thing. They can buy back with $4 billion. But remember, $2.5 billion of that is already going to dividends. So $2.5 billion is spoken for going to dividends. Then they have debt payments, interest payments on their debt of $1.5 billion. So right there, all of their money that they're generating in free cash flow is already going to interest payments and dividends, leaving them no money for buybacks. So as the stock price falls, they have no tool in their tool belt to really buy back the stock. The only way that they could really afford it right now is by issuing more debt. But that wouldn't make sense because then they're increasing the amount of interest payments they have in the future. So this is also a company that doesn't really have an easy tool to be able to fight back on this share decline. And that makes this situation even tougher for them. In order to do buybacks right now, they'd need to cut the dividend. And I don't think they want to do that. So there's a brief overview of the numbers this quarter, of the fundamentals. And anytime a big company like this posts a quarter this bad, this unexpectedly terrible, investors want an explanation, and they want an explanation of the leader of the company, of the top executive, the CEO of the company. They want to hear his side of it. What is going on with our business? What's happening here? Now, I have my explanation. My thought is that it's a caffeine bubble. I think it's very clearly a caffeine bubble. I think caffeine's too expensive. There's too many products, too many competitors, and we're finally seeing evidence of a breaking point. But that's just my opinion. What we see here is the CEO coming on to CNBC and being interviewed by none less than Jim Cramer. Now, say what you will about Jim Cramer, but this interview, this one was a rough one. Jim Cramer really pressed him in this interview. I think it's great, but I also think it's a tough one. Let's go ahead and just tune into it. I'll bring it up here. We have here the CEO of Starbucks being interviewed by Jim Cramer. And right there, he has a face where he's looking pretty upset, and I think rightfully so, because again, Starbucks investors went into this and got blindsided. Let's go ahead and start off here.
Jim, it was a very tough quarter. Thank you for having me. There were 3 reasons for this. First, we saw unexpected pressures on our occasional customers, more intense than we expected, that impacted their visitation. Second, the choppiness of the recovery in China continued with a more intense price war than what we expected. And third, challenges of our business in the Middle East that impacted us not just in the Middle East, but also in other geographies.
Another thing he mentions here is conflicts in the Middle East and that weighing on the business. There is some protesting and some boycotting of Starbucks. I think that's having an impact, but I think companies like to blame stuff like that more than it actually is causing a concern. Starbucks is being impacted by some boycotts, but they're everywhere. They're in every geography, and you're seeing the same type of thing happen in every geography. These protests are not happening in every single geography. So I don't believe that's really a valid excuse for the overwhelmingly and diversified poor performance from Starbucks. Now we continue on with this interview, and it just gets rougher and rougher.
I understand. Now, what I'm trying to figure out, sir, is why did you not feel the need to pre-announce this shortfall, given the fact in the previous quarter, your CFO said that she felt that you could have a earnings per share growth in the range of 15 to 20%. This is a substantial decline from that. And given the fact that you said on the call that April did not end well, I'd like to know why you did not feel the need to come out and say our quarter is going to be substantially worse than expected at least 4 weeks ago.
I think, Jim, we've been working on action plans to address these headwinds. And so what we wanted to come back with was not just the announcement, but also the action plans that we have in place, which...
So just 3 months ago, the leadership of Starbucks was saying they were going to grow earnings by 15%. Now analysts are wondering if they're going to grow earnings in the mid-single digits, 4 or 5%. So the estimates are being dramatically changed.
By the way, are not business as usual. And I'm happy to talk about them.
Well, let's finish, because I know that investors are trying to figure out why they should hold on to the stock. Some of the things that I am confused about, I checked with all the major, both public and private companies that are in a similar business to you, and no one saw a 3% decline in comp stores because of weather, and none of them saw a negative number except for you. Is it possible that your coffee is just too darn expensive?
Such a good question. Again, criticize Jim Cramer for what you want, but this is such a great question. He did all the comps of all the similar businesses, all the ones selling expensive caffeinated drinks, and all of those are seeing growth. Starbucks is the only one seeing declines year over year in their sales. So how is he going to explain this?
Jim, I think that if I look at the U.S. occasional customer, they have clearly cut back on visits to us. If you look at the value for money scores we have, they're still strong. But there's no question that the occasional customer is cutting back on visits to us. We have not been able to communicate to them the value that we provide. So what we are doing about it is, it's not business as usual, but there's an action plan we have in place in order to do that, to reach them and to communicate the value that we are providing.
This line, he sees the big problem with Starbucks right now. Not that their prices are too high, but it's just a miscommunication of the value that they're providing. They haven't communicated correctly the value they're providing. The correct answer here for this CEO is to just say we took too much pricing. We raised prices a little too fast, a little too soon, and so we're going to ease off the gas pedal a little bit, give breathing room. We're going to hold off on price increases. That's exactly what other companies do when they get a little ahead with pricing. They say, you know what, we took a lot of pricing, we're seeing some pushback from customers, so we're going to ease off. We might lower prices slightly in some markets to regain customer traffic. There's nothing wrong with that. There's nothing wrong with a company admitting that they raised prices a little too fast for customers. But instead of doing that, he blames it on a miscommunication of value. They aren't communicating correctly that the price of a drink going from $4 to $6 in a matter of a year is still not great value for customers. I don't think any way that they communicate the value to customers, or whatever he means there, is going to fix this. There's too many alternatives. Starbucks is not the only game in town selling a morning drink that gives you your buzz, that gives you your energy for the morning. So I think this is a big misstep by the CEO here. He had an opportunity to say, you know, we think it's mostly due to just taking too much pricing. We're going to lay off of that. Instead, he focuses on this communication talking point.
What we're doing for that is we are making it attractive for them to come back into the Starbucks app and join it. On the app, what you will see is you will see value that they haven't seen because they've not been part of that environment. There are drops that are going to happen every Monday. There are bundles that we're putting in place that are attractive for them. For example, a beverage and a drink at a certain price. And so what you are seeing there is the effort we're making in order to ensure that our occasional customers get to see the value that we provide. Our loyal customers.
Why did the loyalty program go from 30?
What customers want to hear is that things are expensive right now, and executives realize things are expensive. They want to hear that people are paying attention to their concerns about the ever-rising price for everything. So if he communicated that a little better here, that he realizes, that things are expensive, so they're going to pay attention to that, I think that would come across so much better. But this continues on, and again, it gets worse from here, I promise.
34.3 to 32.8 in linked quarter. I mean, those people are not occasional. Those people are hardcore. Why did your membership, and I know your membership was up 6% year over year. I'm not concerned with that. I'm concerned with linked quarter. Why you had not the occasional, but the hardcore drop off.
Jim, if you look at the most loyal customers, they actually continue to come in, they continue to buy as frequently, they continue to customize and upgrade. It's at the tail of the loyalty program, particularly those that are, in the 90-day active, as we call it. The folks that didn't come back, they again are very similar to the occasional customers. We have an action plan in place right now to communicate directly with them, with offers that have gone out even as recent as this week, in order to ensure that we can reverse the visitation losses that we have seen with them and to bring them back. And yes, you're right. Overall program did grow by 6%.
Right.
So instead of lowering prices, I think the plan here is to give more freebies, offer more little discounts, perks, bundled items and that type of thing, which is something. I think that's a good route to go down. It's better than doing nothing.
That's necessary, but what's more important, I think, is the linked quarter decline. Now, let me, before I turn it over to my colleagues, you said it's not business as usual, and I want to make a point here, sir. You are still expanding as if it is business as usual. You add, for instance, on the quarter, you talk about opening stores in Honduras and Ecuador. Is it not time to pause, sir, and figure out what's really going wrong and spend a deep dive and making it so that this decline in comp store numbers does not continue? Because it is perilous to the actual existential existence of Starbucks.
Jim, thank you for the question. What I would tell you is, if you look across the world, our system sales in Latin America expanded double digits. Our sales in Japan expanded double digits. Our business outside of Malaysia and Indonesia in Asia Pacific showed growth. If you look at the U.S. business and look at the fundamental.
We just went through all the numbers. See the difference between the story he's painting and just the raw numbers? We saw that everywhere in the world, same-store sales is in the negative. But when you listen to him, it's like you're hearing just the complete opposite than the actual numbers in front of you.
Fundamentals of the U.S. business. We are holding share in the U.S. We are still the largest.
That's what he says. We're holding share in the U.S. Starbucks is holding market share in the U.S. Really, Starbucks? You're holding your market share in the U.S.? Really?
Player in out-of-home coffee. If you look at some of the metrics that we have.
Tim Horton said you are not holding share, sir. I regard them as being seminal companies that are just as good when it comes to McDonald's says you are losing share. I can't go against those three companies. They are too good and too honest and too big for me to dismiss.
We are the leading.
So Jim, this is an excellent line of questioning. Say what you will about Jim Cramer, I know, but his questioning here is fantastic. He highlights that the other big companies, you have Dunkin' Donuts, you have McDonald's, saying that they're taking share from other drink companies. They're taking share from Starbucks. And then you have Starbucks saying, we're keeping our share while same-store sales are going down. Obviously, one of them is misrepresenting the situation here.
Category player in coffee. I'm talking visitation share and what we have. If you look at our in-home coffee business, it grew share 140 basis points. But if you look at the business underpinning us, tea grew 8%, cold grew 1%, So there are elements in here. If you look at our partner sentiment and what we have inside stores, attrition is down to its lowest levels. So there's work going in. The thing we didn't do enough of is really attack the occasional customer with delivering and communicating value to them in a more aggressive manner. That's what the plan we have does.
And there you have it. So, this interview did not go well. The stock price continued to fall another 3% after this interview, which is usually not a good sign. When the CEO comes on, they try to defend the stock and the stock falls further. Not a great interview from the CEO, but you hear their plan of attack. To turn this around from the CEO's own plan of attack is to basically offer more freebies and goodies and things to entice people in the app. They're using their digital property to get people back in the fold of Starbucks. I'm not going to be buying Starbucks stock. It's not one that I find attractive enough to jump into. I think there's other opportunities in the market that are far more predictable. But if you are buying Starbucks stock, I genuinely hope the best for you. Now, moving on from Starbucks, we have to talk a little bit about what Amazon did. They just reported yesterday as well. And before we even jump into it, I have to mention that I am invested in Amazon. So this is one that I'm bullish on. I really like the company. And it's up a little bit today. Amazon's up around 1.5%, floating around in the positive today, even though the market's in the red, because the report overall was really good. In my opinion, I just thought it was a decent report, in line with most of my expectations, even slightly better in some areas. We have the headline here from CNBC. Amazon profit more than triples, topping Wall Street expectations. If we look at the top and bottom line here, the earnings per share was a beat, 98 cents versus 83. The revenue was a beat, 143.3 versus 142.5. So we got a beat on the top and bottom line, but of course with Amazon, there's so much more underneath the surface. Let's go ahead and take a look at their segments of their business. We can do this by the revenue segments. So we're looking at revenue here, broken down into different aspects of their business. The first revenue segment we're going to look at is the first party online sales. So this is stuff that Amazon sells, like the Amazon Basics brand, right? You can buy their Amazon batteries. Amazon has actually been winding down their first party brands. There's so many complaints about them. Anytime Amazon sells something, they're competing with someone else. And since they're competing with someone else that's usually selling something else on their same website, people get really upset about it. They say Amazon's stealing all of their secrets and they're copying them and they're selling it for cheaper. And then Amazon quickly becomes the bad guy. So they're winding down their first party online sales and they're taking off hundreds of their first party brands. This has made it so that last quarter, they didn't grow their first party sales that fast at all. If you look at it, it went from 52.97 billion to 54.67 billion. Now it's funny in Amazon's case to say that it grew by $2 billion, and that's like no growth at all. But in reality, that's really minimal. That's growth of like 2%. So this portion of the business is not growing fast. Amazon is not focusing on it. It's caused them a lot of grief with regulators and people complaining about them competing, and they don't really need it. It's also a low margin portion of their business. So they're not focusing on growing this. It's not a real intrinsic value mover for the company. Even if they make a lot more money in this segment, it's not going to move the needle for Amazon. Now, when we move on to physical stores, this is another part of the company that's more concept stores, trying out new things, and mostly at this point, Whole Foods. So they own Whole Foods. They're trying to integrate that into Amazon as much as possible. And it's not growing the fastest, but we are seeing some steady growth with their physical stores. I have to say, there's a nice gradual line of increase. Ever since 2020, it's increasing nicely. Not the fastest growth ever, but again, this is another portion of the business that I don't consider intrinsic value moving. I don't think it's the biggest, most important part of the company. When we move over to the third-party seller services, this is really important. This is where they host other third-party sellers and allow them to sell on their platform. And then they provide a variety of different services and charge them for those services if those sellers choose to use them. More and more sellers are increasingly choosing to use Amazon services, and they're pricing the services more aggressively because they know the value they're providing. Third-party seller services grew by 16% year over year. Then we have advertising. This is another pillar of intrinsic value. This is something that will really move the needle for Amazon. We had high hopes here. I had high hopes that it would be good. I didn't know the exact numbers. I couldn't predict it with exact precision, but based off of Meta's report, based off of Google's, based off of LinkedIn's, I knew this was going to be really fast, and it was really fast. This grew at 24% year over year, going from 9.5 billion to 11.8 billion. And no matter what people tell you, if someone says 24% was slow, that's just not accurate. 24% is very fast growth for a business doing this much this quickly. They spawned this business out of nowhere just a couple of years ago, and already it's doing $12 billion per quarter. Last quarter before that, during the holiday season, it did $15 billion. Advertising is a monstrous portion of this company, a monstrous portion of the value proposition. We move on to the subscription businesses. This is another one that it was right in line with my expectations. I said that this one would just be steady. I didn't predict anything spectacular with it. I thought it would be steady just like it is throughout its entire history. And that's exactly what happened. It grew by 11%. So this was steady growth from the subscription services, which is really good as well, because this is another high margin portion of the business. Then we get to AWS. This is what's creating the profits for Amazon today. AWS grew quickly. It grew much faster than expected. Analyst estimates were for it to grow 14%. That's what Wall Street was expecting. They grew it 17%. So far above Wall Street's expectations. Now, other doesn't mean anything. It's not a category I pay attention to. When we look at the high quality businesses, the ones that Amazon's really trying to grow, the ones that drive the intrinsic value of the company higher and higher, we have the third-party seller services growing 16%, advertising growing 24%. We have subscription services growing 11%, and we have AWS growing 17%, re-accelerating over last year's growth. The four most important segments of the business are all the fastest growing segments. And out of these four, I even think that these three are even more important. These are the three most important segments. It's difficult to say what is the most important. They all play a pivotal role. But when you break this down, you have a company that has a high amount of concentration into really incredible industries, concentrated into online sales, concentrated into advertising, and concentrated into cloud hosting. They're in such an enviable position. Every company on earth would love to be in Amazon's position. Now, another key performance indicator we can look at for Amazon is with AWS. Right here, if we go back to this chart, we have AWS's revenue. So this is Amazon Web Services revenue on a quarterly basis. It reached $25.3 billion last quarter, which puts it at a run rate of $100 billion. So you have a company now, run rate $100 billion, and we want to look at other key indicators to see how this is growing in the future. One of them that we can look at is this right here. AWS customer commitments. These are large customers that have signed contracts with AWS to use their business that the contract length is over 12 months. So these are long-term customer commitments and how much unearned revenue that Amazon has. When we look at this, last quarter it went up again from $155.7 billion to $157.7. Now, we don't know exactly when the customers will use this revenue, but it's going to be over like a 4-year period. This is already money that people have committed to AWS that they haven't paid yet. Another $157 billion. So when we break down all the revenue into those segments, I think it looks strong across the board. All the major segments I look for are growing, at least with my expectations. But when we look at an overview of Amazon and all the basic financials of the company, it also looks relatively strong. From my perspective, I don't see many weaknesses here. The overall revenue grew 12.5%, beating analysts' expectations. The reason that they continually beat expectations is because they always set the bar low. Amazon is one that under-promises and over-delivers. They always come in at the top end of their revenue guidance. So no surprise they beat expectations again. The EBITDA, all this stuff is improving. We can look at the free cash flow. This one's a little bit tricky, but if we zoom in here, we can see that last quarter, it was $4.06 billion. Now, I give a range between $4 to $10 billion. So again, this is in line with expectations because they'll throw in a lot of expenses, a lot of working capital into this quarter. But we look at this on a year-over-year basis. It was minus $9.42 billion last year on the same quarter, and positive 4.06 billion this quarter. I believe that the remaining quarters will be very, very big quarters, but this is off to a great start. We look at the net income. They posted another net income quarter above $10 billion. So you can see the gradual increase reaching record high after record high. This is going to continue to go up. The earnings per share were a massive beat. We have the company's earnings per share climbing 216%. That's not an error. If we go back 4 quarters ago, it was 31 cents. We go to this quarter, it was 98 cents. If we look at the balance sheet of Amazon, they took on some debt to pay for all of their expansions during the COVID boom. But we look at this now, and the debt has been going down routinely over the past year. And this is something that they mentioned on their earnings call. They don't like the debt. They want to get rid of it. They're paying off debt steadily. In fact, one of the reasons when we look at their shares outstanding that it's actually going up and not down is because Amazon right now is not concerned about the dilution in the shares outstanding as much as getting their balance sheet in order. They basically said, in fact, it was the CFO of the company saying, look, what we're doing right now is we're not paying a dividend, we're not doing buybacks, but instead we're going to get our debt paid down to a very healthy level. They don't like having this debt and the high interest payments. So they're going to continue paying down this debt and get that down first. And then I believe they'll transition to the dividends and the buybacks. That's the order that Amazon said they're going to go. So a lot of investors were kind of antsy, waiting around, hoping that Amazon would launch a dividend and say this is going to be their first quarter because we had Google do it and we had Meta do it. But Amazon doesn't really follow the pack. They want to do things in the order they want to do it. And that would be one of the criticisms that I think a lot of people have about this quarter. As of this quarter, they are not returning capital back to the shareholder. Really none of it. They're not paying any dividends. They're not doing any buybacks. They're paying down debt and they're investing back in the company. So no capital return back to the shareholder is something that you can take both ways. You can say that that's really bad. You want to focus on companies that have capital return, or you can say that you're happy they're paying down debt and you're happy they're reinvesting back into the company. Two ways to look at it, but right now that's something to keep in mind. Overall, I would say that's the single biggest shock to me this quarter. I thought they were going to announce either a bigger buyback program or a very small dividend. I thought they'd do something in terms of capital returns, but they didn't. They just said they're not doing either right now. They're focusing on the debt. Now, if we move further down the financials, another thing that I think soured Wall Street a little bit is the CapEx of the company. If we look at the CapEx over the past 10 years, you can see that Amazon was focusing on efficiency over the past year. The CapEx was going down as revenues were growing, and that painted a nice image that they could continue doing this. That was the talk over the past year. Efficiencies and capital efficiency, focusing on profits, churning out free cash flow, that type of thing. So a lot of investors, including me, thought that they would continue with this trend, but then AI happened. AI happened, and it puts a kink in these plans. Amazon said, you know what? We thought we had enough server capacity. We thought we had enough investment into AWS. But then there's so many customers coming to us saying that they want AI training, they want inference, they want hosting, they want usability for AI. And we don't have enough capacity right now. So what are they doing? What does Amazon do when they don't have enough capacity? They build and build and build. They announced on this call something that was, again, unexpected to me, that this most recent quarter here would be the lowest CapEx quarter of 2024. So instead of the CapEx going down, it's going up. Now, the reason it's going up is not because of low margin retail. It's not because they're investing in, random projects that the CEO wants to invest in. It's not because they're investing in rockets or anything like that. It's for AWS. They're investing more into AWS, and that's where primarily their CapEx is going to be spent. Now, they also mentioned on the call that some of the spend that goes towards AWS does support the retail business as kind of like a second benefit, but primarily it is for AWS, and it is because of AI. They're investing more in AWS to support all the AI demand they have. And they already said that AI on AWS is a multi-billion-dollar business. So they didn't disclose the exact amount they're making, but they said they're already making multi-billion dollars in AI revenue, real revenues from AI. So again, there's two ways to take this. You can be bummed that they're kind of investing more into AI. You can believe that they should cut back on that. Or you can say, you know what? I really believe in AI. I believe that they're going to get a very high return on these investments. So I want them to invest more. I want them to build out more data centers so that I make more money down the road on this. Overall, I think that Amazon investors should be happy right now. They're getting the best of both worlds. They're getting a company that's expanding margins, growing net income, growing free cash flow aggressively year over year, while still investing in growth for the future. They're doing both of it. Growing in the future, making good investments today while expanding margins and growing profitability. So I believe fully that Amazon's still on track. I think the company is doing great across the board, and I look forward to its progress in 2024. Now that's going to be it for this episode. Remember, if you want to try out the Patreon, today's the day to do it. You can join today for free and get a month-long free trial. There's a link in the pinned comment below.